Hey, welcome to the Tax Turmoil Takedown webinar. I'm Adam Short. Appreciate y'all joining us today. And today we're going to talk about how to prevent, crush, and end IRS nightmares. This is something that's very familiar to lots of people dealing with IRS problems, and we hope to kind of unpack some of those problems and unpack some strategies on how to actually become a winner in your IRS tax case. So looking forward to going through that with you today. And we are recording, so if you have any questions, if you decide to ask a question later during our Q&A time, please keep in mind that anything that you share is public. So we just ask that you don't share anything that you wish to remain confidential. This is a 90-minute webinar. We may or may not take the full 90 minutes. We'll see how it goes. But we did allow 30 minutes of time for questions at the end if there are any questions. By default, you are muted in the webinar. So if you would like to ask a question at the end, we will ask that you click the raise hand button, which is at the bottom of your screen. And then we'll get notified when you click that and we'll unmute you. Or actually, I think you'll have to unmute yourself to ask a question. So other than that, we appreciate you being here today. And I do want to introduce Lacey, who is our illustrious administrative assistant. And she'll be here to help navigate through questions and any issues that might come up. Thank you, Lacey. Appreciate your help. All right, so let's dive in. A couple housekeeping things to mention before I get into the content that I just want to get out of the way ahead of time. I did mention 90-minute webinar, Q&A at the end. We are recording, so again, anything that you say, in the chat or on the audio will be recorded in public. So just be sure that you are aware of that if you disclose any information. For anybody interested, we will send you a slide deck and the recording of the webinar afterwards and make that available. And again, if you have any issues, please just click the raise hand button at the bottom of your screen, whether you're on a mobile device or your laptop, and we'll try to help you. Again, if you have any questions throughout the webinar, please just chat those in on the chat feature. All right, let's get started. Okay, so just a little bit about us and who we are. So we're a tax and accounting firm, and we do specialize in helping businesses, business owners, and entrepreneurs making sense of tax and accounting and business. That's our sweet spot, our bread and butter, if you will. And we also specialize in tax resolution, which is the world of IRS controversy, where we help to resolve issues that you might have with the IRS, whether they be audits, collections proceedings, and any number of other types of controversies and issues that arise with the IRS. So if you would like to contact us to discuss your case or your business, your tax picture, please don't hesitate to do that. We'd be happy to talk to you about that more detail and see if we can help you. A couple disclaimers about the content in the webinar today. This is general information and it's for informational purposes. It's not legal advice. It's not tax advice. So please understand it is general. Each tax case is specific and unique and has specific facts and circumstances that are unique to your situation. So if you need specific guidance about your situation, please always consult a qualified professional, whether it be us or someone else. The content in here is current as of today, December 14th, 2023. Tax law, regulations, and rules change constantly, so please be aware of that. Everything we're sharing today is current as of today, but tomorrow, the rules and the laws could change. Again, also, this is copyrighted material. Please do not distribute, promote, sell, or market this content without our permission, and we appreciate that. All right, let's dive in and get to the meat of the presentation. So I wanted to start with, first of all, a real world story that we've had in our firm. This is a real client case that I want to share and kind of just walk you through kind of what happened, and how we were able to represent the client and secure a favorable outcome for the client. So essentially, the facts of the story, facts of the situation with the client was they were a client that had not filed their tax return since the mid 90s, okay, since 1994 to be exact. And they came to us, it's about 5 years ago. They came to us and said, hey, we haven't filed a tax return since 1994. And of course, you don't get that every day. It's uncommon to meet people who haven't filed a tax return in a couple decades. But in fact, they were in that category. And so they obviously, and it wasn't because they were attempting to avoid, evade taxes or anything like that. It's just they were busy business owners, and they just, got busy and didn't file their tax returns. We said, hey, we can help you. We got the client caught up in filing their tax returns going back 6 prior years. That's one of the nice rules that you can use when you have unfiled tax returns is you don't have to go back to 1994. Matter of fact, the IRS prefers that you don't unless it's for very rare circumstances. So we filed the prior 6 years tax returns, okay? And as you might imagine, after filing that many years of tax returns, the client owed the IRS over $250,000, so over $250,000, a lot of money. And so all of a sudden, here they are facing a multiple 6-figure tax bill. And then of that amount, 100,000 approximately, almost 100,000 was just penalties and interest. So you can see how you have a tax that you owe, and then on top of that, it snowballs. You get penalties and interest that just continue to snowball. So obviously, they were very worried. They actually were worried that they were going to go to jail. And I will say, I'm not an attorney. We're not attorneys. So if you're worried about going to jail, talk to an attorney. We work with tax attorneys. We can refer you to very good tax attorneys that will do that very thing, that will do their best to keep you out of jail. But the bottom line is they were extremely worried because they had not filed a tax return for over 20 years. And so now they're in a situation where they're afraid of what could happen. And so what we did in approaching the case, it was multi-pronged. We were able to, like I said, get the tax returns filed. Then, of course, you get the confetti. The mailbox is full with the IRS letters and notices and stuff. So what we did is we prepared and negotiated what's called an offer in compromise, or an OIC. And really what this is a legal settlement with the IRS. And there are very, very specific, stringent rules to qualify. It's very difficult to qualify. But we were able to submit this settlement offer to the IRS, and we were able to reduce the client's balance to about $35,000, down from $250,000. Okay, so now you're down to 35,000, which is about 13 cents on the dollar. And so, needless to say, the client was very happy with the outcome, and we were able to help them significantly. So this is just an example of one of the many things that we can, tools that we can use with representing you and others before the IRS, especially if it's a large dollar amount, okay? All right, so that's a real world story. Let me switch now to really what I would call the top 10 mistakes when dealing with the IRS. These are things that we've seen in real life that are patterns, right? That seem to continue to occur and cause other problems in the future with the IRS. So there are more than 10, but 10 are the ones that I picked that I've seen most consistently. So these are things that you don't want to do, okay? And it's very tempting to step in one of these landmines. This section of the webinar is about avoiding IRS landmines. So we want to do everything we can to avoid those traps and prevent any trouble from happening. Even if you're not in trouble, so to speak, right now, you don't have a tax issue, there are landmines that could be stepped on. So we want to make sure you avoid that. We want to keep you out of those landmines. So first of all, the first one is really probably the worst one, and that is procrastinating and ignoring the IRS, okay? And, I've seen this so many times, I can't even count it. you're getting nasty grams, right, in the mail from the IRS. And you don't want to open them. I mean, when we get a letter from the IRS, even myself, if I get one, I do this for a living. I represent people for a living. But if I get an IRS notice, I'm a little nervous, right? Like, what are they going to tell me? Am I being audited? Or what is it that they want to tell me? And so it's very tempting to say, okay, no, I'm not going to deal with that. I've got more important things to deal with. Surely they'll give me more time and the problem will go away by itself. It will not. It will get worse. Okay. And the longer you wait, the worse the nasty grams get. And eventually you'll get one that will be certified mail. And then you'll wake up one day and you'll start noticing money taken out of your bank account, which is called a levy. That's a real extreme example of ignoring, but I have seen that happen. So don't ignore. If you have a problem or you think you might have a problem or you've been contacted by the IRS, definitely face the problem. It's not going to help you put your face or put your head in the sand. Okay. Number two is, and we see this a lot in our firm. This is a common misconception, and it's an honest mistake, but it's something to be aware of, at all times. And that is, when you file a tax extension, it does not extend the deadline to pay your taxes. It only extends the deadline to file your tax return. We get that question almost every year, I think. So April 15th, right? That's the deadline to file your tax return generally each year. And, people say, well, I'm not ready to file my tax return yet. Okay, great. File an extension. Well, you still have to pay your taxes by April 15th. That deadline does not get extended. So remember, pay your taxes by April 15th, even if you can't file your tax return by then. Number three is filing or paying your taxes late. So whether it's your tax return you're filing late or paying your taxes late, I mean, that's obviously a common one. It goes without saying, but it's a very common thing. And it's definitely something that you want to avoid. Most of the trouble to begin with can be avoided if you just file and pay your tax return on time. Okay. This is also a very common one that we see, and it's honestly a innocent mistake most of the time, just because of disorganization or forgetting about certain income. And it's when people forget or fail to report all of their income on the tax return. I get questions a lot that say, well, if it's under $600, I don't have to report that on my tax return, do I? Actually, that's not true. That's a myth that gets circulated. I'm not sure where that originated, but you have to, even if it's $1, even if you don't receive a 1099 or a W-2 for that income, you have to report that on your tax return. Okay, so just remember, if you forget or fail to report income on your tax return, the IRS likely will know about it because they are receive their information about your income from third parties like banks and employers. Okay, so that's number four. Number five is deducting personal expenses on your tax return. Fill in the blank. We've been asked, is XYZ deductible on my tax return? Is my cruise deductible because I went on a cruise to Bermuda and I had a business call while I was on the cruise? Sorry to be the bearer of bad news, but your cruise is not deductible. So deducting personal expenses on your tax return is definitely a no-no. And this is more common with business owners where they mix their business and personal. And so you end up having, some personal expenses that you thought were business. You have to keep good records, make sure that your personal is separate from your business, and you do not deduct personal expenses on your tax return. Okay, that's not deductible. Next one is misclassifying. This is more for business owners, but we see this a lot too. If you have a business and you say, well, I want to hire a contractor, a 1099 contractor, and I'm going to issue them a 1099 at the end of the year. Maybe they're coming in and they're your personal assistant, or maybe you're in the construction business and they're painting houses for you, or fill in the blank, whatever the job is. A lot of business owners gravitate towards saying they're 1099 contractors, but it's very common to misclassify contractors and when they should be W-2 employees. And there's a lot of there are a lot of factors that go into determining whether they are a contractor or whether they are employees. But if you control their work and you tell them when they come to work, how they do their work, and you give them the equipment to do their job, then that's an employee relationship. If the person has their own equipment, they have other customers and they work for other people, then they're probably a contractor. But it's very risky to misclassify as contractors. Next one is if you don't keep clear and organized records of income and expenses and receipts too, mileage logs and things like that. That goes without saying, but always keep your receipts for business deductions and even personal tax deductions like mortgage interest, state and local property tax, charitable contributions, and medical expenses that are out of pocket. The next one here is assuming that the IRS is always right and that you cannot challenge them. I will tell you that the IRS is very commonly wrong, okay? They make mistakes just like any other company or organization would. There are tens of thousands of people that work at the IRS. And believe it or not, some of the computer systems that the IRS uses were built during the Kennedy administration in the 1960s. So needless to say, some of the systems, and this is not, I'm not making this up, it came out in the Wall Street, I think it was either Washington Post or Wall Street Journal last year. There was an article about, somebody was let in, a journalist was let into the IRS campus, and one of their computer systems was literally held together by duct tape. And so you can't make this stuff up. I mean, computers are 60 years old, they're going to break and they're going to make mistakes. So the IRS is not always right. Just because they say something's true doesn't mean it's true, and you can challenge that. The next one is providing information or more information to the IRS than they ask for. This is a common trap, especially if you're being audited. They might ask you for specific information, and then you start to divulge more information that's not necessary and get yourself in more trouble. This is when it's really good to have somebody represent you, where you're not disclosing additional information that opens you up to more scrutiny. And then the final number 10 here is failing to hire a professional when you're in it over your head. So it's very easy to get overwhelmed with the IRS and get to the point where like, I'm not getting anywhere, I don't know what to do. And that's when you probably should hire a professional. Okay, so those are the top 10 mistakes when dealing with the IRS. And now I want to get specific with some of the landmines, okay, and how to avoid. There's specific landmines I want to talk about that are very common. And this first one here is called mismatch notices, or CP2000. Okay, and what this is, it really is an audit letter that lots of people receive, and it looks like this. This is a public version that I found on the internet. It's not one of our clients or anything. This was public. So anyway, if you look at the top, you probably can't see it, but it's a CP2000 at the top right up here. And it will look like a tax bill, but it's not a tax bill actually. It's a proposed amount due. It doesn't mean that amount is due. It means it's proposed, meaning it's penciled in. It's not official. Okay. So how do these happen? What triggers these CP2000 mismatch notices? They're usually caused by a situation where you either underreport income or you omit income that the IRS has received information about from another party, such as a bank, investment firm, employer, customer, etc. So really, it's like the most common examples are 1099 or W-2 that you forgot you had that you didn't report on your tax return. Okay, so you worked for Acme Enterprises for part of the year and you had a $10,000 W-2 and you just forgot to put it on your tax return. So 6 months later, you get a notice. And so the nice thing is, though, if you don't get a notice yet, okay, let's say you filed your tax return and it's April 15th and then May rolls around, you're like, oh my gosh, I forgot to put this Acme $10,000 W-2 on my tax return. If the IRS has not contacted you yet, there are some other rules that are required here that you have to meet. But generally, if they have not contacted you yet, you can file what's called a qualified amended return. And then you can get ahead of the problem and solve the problem before it even becomes a problem. And that usually will keep you from receiving that audit notice, and you won't be penalized either. But let's say you do forget, you get the notice, they're going to send you this CP2000 letter, and they're going to propose that additional tax, penalties, and interest are due. But there are ways to contest that. There are ways to reverse that, and I'm going to talk about that. Moral of this story is keep all of your records, keep all your tax records organized so you don't forget to report any income. Okay, keep all your W-2s when you get those, your 1099s, your K1s, any tax form that you get, your 1098s, 1095s, fill in the blank. There's a million of them out there. Just make sure you put them in a folder, or if you do it digitally, put it in your, your storage drive on the internet somewhere on the cloud. Okay. Landmine number 2 is being ghosted by the IRS. And I have seen this time and time again. Let's say you're in a situation where you've moved, okay, and you filled out the change of address form with the USPS, but you didn't fill it out with the IRS. And so the IRS doesn't know that you moved to another state. And so they're sending you letters to your old address, and the post office is not forwarding them to your new address. So the IRS doesn't hear from you. They think that you're ignoring them, and you think that you're getting ghosted when you're trying to contact the IRS, and you're not getting anywhere because they're sending letters to the wrong address. So you're basically crossing your wires. So this is a real simple one, but it's one of those that can become very complicated really quickly. And the way to get ahead of this and prevent it is you just change your address. You file the 8822 form, or if it's for a business, it's 8822-B. So that's the moral of that story. Make sure when you move, change your address with the 8822. Also know that when you file a tax return and you put your new address on there, that will update your address with the IRS too. If you still can't get anywhere and you're getting ghosted and stuff, you can involve what's called the Taxpayer Advocate Service, which is an independent branch of the IRS that they actually have the authority to issue orders for the IRS. It's kind of like a court. All right, number 3, this is landmine number 3, bullying and power trips. And I've seen this with IRS agents. Some of them are just, they're abusive. For lack of a better word, they're just abusive, and they have a power trip, they have a chip on their shoulder, and they seem to be determined to make your life miserable. No matter how much you try to work with them, they stonewall you, and actually, frankly, they can bully you. Just know that if you end up in a situation like that, if you get an auditor that's a bully, you do have options. Okay. Rule number 1, when you interact with an IRS agent, rule number 1 is the first thing you ask them, and we do this when we represent clients, you say, can you please provide me with your group manager phone number and name? And I would like to write that down. Some of them will say that they're not permitted to give that information out, but that is actually false. They are required by law to give that information. So before you even get in a situation that might be bullying, you have their group manager name and phone number that you can go above their head if you need to. Okay. That's one of the easiest ways to navigate a situation where an IRS agent is being abusive. Another thing that can come up, this is more for in-person IRS visits. If you are visited by the IRS, whether it's a revenue agent, revenue officer, or criminal investigator for certain criminal CI officers, you have the right to stop the IRS interview in person if you would like to consult with your POA, your power of attorney, first. Now, your power of attorney can be an enrolled agent like myself, or a CPA, certified public accountant, or an attorney. Those are the 3 categories of POAs that can represent you before the IRS. The agent must stop the interview unless it's a summons. If it's a summons, you're going to have to sit through it and answer the questions. Okay. But if it is not a summons, they are required by law to stop the interview, even if you haven't answered any questions, and even if you have. So that's an important thing to know. You also do have the right to not be present at an IRS interview or a phone conference Instead, you can delegate your POA to be present there on your behalf. That's what we do as a matter of practice. If we're representing a client, we actually require that the client not be present. It's on purpose because we know what to say and what not to say, and to secure the best outcome for you. So we don't really want you there. And then the last thing here, the moral of the story: document all of your questions or all your conversation with the IRS. You need to know your rights. There's a taxpayer bill of rights. The IRS is required to follow it. And remember, you can stand up to bullying by IRS agents. And actually, if it gets that bad, if it gets to the point where you really can't get anywhere, even with their group manager, you can file a complaint against them with what's called the Treasury Inspector General for Tax Administration, abbreviated TIGTA. And I've done that before. They are federal law enforcement agencies, and they have oversight. They have federal law enforcement oversight over IRS employees, and they will investigate. Okay, so let's move along here to some real world strategies that we have used in our firm. These are IRS strategies that we use with representation of clients. And I've got a few I want to go over with you today. So number one is prove the IRS wrong, how to do that. Number two is how to reverse an audit finding. Three is how to remove penalties. And number four is how to cash in on missed tax benefits. Those are the four strategies I want to go through with you. But before I get into the strategies, I want to talk about kind of the ethos and the framework we use in our firm to approach these cases. It's really a threefold layered approach that most often results in success and a positive outcome for clients. So it's documentation plus knowledge plus negotiation equals success. So I'm going to kind of break down what that looks like in each of these strategies. So the first one is how to prove the IRS wrong. And again, documentation plus knowledge plus negotiation equals success. So to kind of get in a little bit more deeply on this, proving the IRS wrong. So let me give you a scenario that I've seen. I've seen a version of this in real life. These are made up W-2s, and you probably can't see these too clearly on your screen, but basically what's going on here is you have two W-2s, okay? One of them is right, and one of them is not right. And if you look really closely, one of them has an extra zero on the box one salary amount. So on one of them, the salary amount is $128,734, okay? On the other, it's $1,287,340. So they added a zero by accident. Somebody typed an extra zero at the employer. Your employer added an extra zero on your wages. Yeah, you wish you had a $1.2 million. I wish I had a $1.2 million W-2. But here's the problem. You get the W-2 of the mail and you file your tax return with the correct information with 128,000, and all of a sudden, like 6 months later, you get a notice from the IRS that you're being audited. So which one's correct and what do you do about it? Well, obviously the one on the left is correct, 128,000. The one on the right with 1.2 million is incorrect. So here you are, through no fault of your own, you're being audited because the IRS claims that you underreported $1.1 million of income, which you know is not true. But the IRS doesn't know. All they know is you have a W-2 that was reported for you for $1.2 million. And so now you're in a world of hurt because the IRS has sent you an audit notice saying that you owe $1.1 million in additional underreported income. This is a major issue, but yet there is a simple fix to this, okay? So let me talk about the fix. So really what this comes down to is obviously the employer has issued and filed an erroneous document. So you need to contact your employer if you haven't already. You need to contact them and tell them, look, you issued a W-2 with one extra zero, like $1.2 million in salary. And it should be 128,000. You tell them that you need a corrected W-2 to be generated and filed with the IRS. There's a specific W-2C. The C stands for corrected. So if the employer files the corrected W-2 with the IRS, that is step one in getting progress in solving this problem. Okay. Now, the next thing is you need to read the notice the IRS sent you very carefully. Read it very carefully, extremely carefully. You need to understand it. You need to know what the instructions say to do, what the next steps are, especially if you're doing this yourself and not being represented. The next thing is, once you have the corrected W-2 from your employer, you contact the IRS, you present them with this correct W-2, okay? And you give them an explanation letter to say, hey, this is what happened. My employer issued me an incorrect W-2. Here's the correct one. Please adjust my account accordingly. The additional income was erroneous, okay? This next one is extremely important. Sometimes, actually, oftentimes, the IRS will send taxpayers documents to sign, and people will just sign them without reading it. You just, okay, well, I have to sign this because the IRS is going to make me sign it. No, you do not have to sign it, especially if it is a consent to assess tax, and the IRS is saying, we're requesting your permission to assess you with the X additional tax. You do not want to sign that. Okay, you want to consult with your representative, such as us or someone else who's qualified to represent you before you consider signing. And if you still can't get anywhere, if you've tried all of these steps and you still can't get anywhere, hire a professional. Okay, so back to the formula or the framework here. It's documentation plus knowledge plus negotiation equals success. And I've just given some examples here of documentation. So I mentioned the W-2 that's corrected. I've mentioned, or I didn't mention yet, but the others are 1099s, whether they're 1099 MISC, 1099 NEC, INT, B, S, etc. So INT would be an interest income statement. A B would be a brokerage firm if you sell investments. An S would be if you sell your home. Those are the kinds of 1099s you can get. There are others, but those are common. You can also use an affidavit. An affidavit is a sworn legal document where you're basically affirming under penalty of perjury of certain facts, and you can use an affidavit as proof and substantiation with the IRS. Financial statements is another way to document, whether it be business financial statements or you have a financial statement from your bank, whether it's a bank account statement, it's a credit card statement, it's a loan statement, a mortgage. Receipts, credit card charges, those are very valuable when documenting and proving to the IRS that you've had certain expenses. Canceled checks, if you even use checks, not many people do anymore, but if you do, you can use canceled checks, copies of checks that prove that you paid X, Y, and Z to such and such. And then, of course, an explanation letter is always helpful too. Knowledge is literally power when it comes to the IRS. So a few things to know are know your facts, know exactly what happened, know the law and the regulations, and if you need to research it, consult a qualified professional to give you input, know what to disclose, know when to disclose it, and know what not to disclose as well, because that's very important. It's not that we're looking to hide from the IRS, but there's specific information that they ask for, and you give them what they ask for, nothing more. That's really what that's about. Know who you're dealing with. What type of agent are you dealing with? What branch of the IRS are you dealing with? Which agency or which division of the IRS has jurisdiction of your case? And just know that certain people are lower and higher on the totem pole and have narrow latitude to do anything or wide latitude. Okay. Know your rights as well. Negotiation is very important. Some would say that life is a negotiation. And I will tell you that working with the IRS is a negotiation. There is a give and take for sure. I would say going in, before you even talk to them, decide up front what you will and will not concede. So if you've got a dollar amount in mind, have that as your amount in your head, and then work backwards from that. It's wise to not show all of your cards up front so that you always have a backup plan in case one of the options doesn't work out. You want to be firm but professional. You can be assertive and firm with the IRS. It is entirely not only acceptable but necessary. Hold your ground. You know, there are times when you're going to lock horns with the IRS, and you're going to have to hold your ground with the supervisor, manager, or appeals officer, whoever it is. So, but sometimes you do have to give up a little bit too. And then eventually, hopefully, you have success. And don't assume you have success just because somebody on the phone tells you that, okay, at the IRS. My philosophy is don't believe anything that the IRS says until it's in writing. And even then, sometimes it's suspect. So even if they tell you, you definitely want to write down who that person is you talk to, their badge number, write down what they said, but request specifically that they give you confirmation of what they've decided in writing, because otherwise you don't have recourse if somebody says, well, we don't have any record of that occurring. So, and then repeat back to the IRS agent what you heard to make sure that you understand it. And if it wasn't correct, they'll correct you and you'll get it correct. Okay. So that is kind of one of the ways you can prove the IRS wrong. Let's talk about the next strategy, which is reversing an IRS audit finding. Okay. So many people are scared to be audited, and yeah, it can be scary. Okay. But an audit is not the end of the world. There are lots of options available if you get audited to navigate those situations. So let's kind of dive into the audit piece a little bit and what to do. So this is an example of what's called a statutory notice of deficiency. You cannot miss it. It will come by certified mail with a signature required. The mailman will come to your door and they won't deliver it unless you sign. You actually have to sign for it. So what is statutory, or a SNOD is the abbreviation. Sometimes you hear SNOD. What this is it is a legal document that gives you rights under the law. Okay. And there are a number of ways how these can be issued, but usually the most common way they're issued is you get audited and you cannot agree with the auditor. Y'all cannot get on the same page on what what the outcome of the audit should be. Some people don't realize that you can actually not agree with the auditor and just say, well, I'm not agreeing with you. I'm not signing any of your revenue agent reports or 4549s or whatever it is. I'm not going to sign it because I don't agree. You're not allowing these legitimate tax deductions. And sometimes they do that. And you have no choice but to just let them go ahead and send you this statutory notice of deficiency. And this is a proposed increase in tax and a notice of your right to a challenge. Okay. So it's very important because when this letter is issued, there will be a date at the top right corner, and you have 90 days from the date that this date cannot be extended. It cannot be extended. You have 90 days from the date on the letter to file a petition in United States Tax Court. Okay. And let me catch up here. I didn't put the text in here yet. Let me catch up here on the slide. You got the SNOD. You have 90 days to file a petition in tax court. So what does that mean? So you file a tax court petition within 90 days. Okay. This is a strategy we use. Even though we're not tax attorneys, we will assist clients in directing them to file a petition, what we call pro se, which means you're not being represented by an attorney at tax court. You can choose to be if you would like, but what we're doing is we're not actually seeking to go to tax court. Okay. The client signs and files a petition. It goes in electronically to United States Tax Court. And then what happens is your case gets docketed in the U.S. tax court system. Okay. And then immediately the IRS attorneys are notified that you have filed a legal tax court petition. Now, what does that actually do to your case? It kicks it up several notches, way on up, pretty high on the totem pole. And normally, most of the time, what happens is the tax court will actually send the case back to the IRS, to IRS appeals, which is a independent branch of the IRS that has authority to review IRS decisions and procedures and findings. Okay, so our strategy is we want to kick it up to tax court so that tax court will then send it to IRS appeals, and we're gonna actually go way over the auditor's head. We're gonna go so far over the auditor's head they don't know what hit them. Okay, and I can tell you this works. I've done it, and it's really cool. So now all of a sudden you're in front of an appeals officer, and the appeals officer has the latitude to negotiate and get a deal done. Okay. You go over everything with the appeals officer and say, look, the auditor didn't allow my business tax deductions that I have receipts for. I've got bank statements. I've got everything that you require. The appeals officer said, oh yeah, great. That looks great. I'm going to overrule the auditor's decision, and I'm going to grant you what you asked for. And then all of a sudden you're in a situation where your audit is reviewed by the appeals officer, and the finding of the auditor, the findings are now reversed. And not only are you not only are you not looking at a huge tax bill anymore, they're going to actually allow your deductions, or you might be in the middle or something like that, but you're going to be way better off than you were before. So this does work, and it's very effective. Okay, so strategy number 3 is how to remove IRS penalties. Again, same formula: documentation plus knowledge plus negotiation equals success. So penalties can accumulate and snowball very quickly. And this is what I call the tax penalty interest tornado. And it is quite the tornado, actually. And we've seen situations a lot where the tax amount might be, pick a number, $10,000, but by the time they add penalties and interest to it, it doubles or could triple, depending on how long it's been, because the longer you wait, the more money they say you owe. So here are the levels, okay, the layers. At the bottom, you have the original tax. Maybe it's $1,000 in tax, okay? And then on top of that, guess what? You've got, what if you filed your tax return late, you paid your taxes in July instead of April. Okay, now you've got failure to file and failure to pay penalties on the second layer. Okay, next you have interest, because the IRS is not a free money machine. They're going to charge you interest on the original tax. Okay, so the original $1,000, they're going to charge you interest on that. But that's not all. To add insult to injury, now they're going to charge you interest on the penalties. Okay, so however much, whatever amount of penalties you have, you're going to now have interest on the penalties. And then the longer you wait, they're going to charge more penalties and interest on that whole balance. And it turns into this tornado. It's terrible. And so, unfortunately, situations like this happen. And sometimes people get into these situations unintentionally because they had something really bad happen in their life. And I'm going to talk about a real story in a minute. But you can get these penalties removed. There are several things that you can do here. Okay, so every taxpayer gets what's called the first-time abatement. And the first-time abatement is something you can get over the phone up to a certain dollar amount. They don't tell you how much dollar amount is, but you can do it for failure to file penalties, failure to pay, and failure to deposit penalties. You can't do it for accuracy related penalties, which is a whole nother type of penalty. You cannot do it for civil fraud. So you can actually call the IRS, and if you filed your tax returns on time and you paid your taxes on time for the prior 3 years, you generally can qualify for what's called a first-time abatement. Okay, that's what the compliance required means. It means that you have to have been compliant for the prior 3 years. Now, what if that doesn't work? Then you can use what's called reasonable cause, which is you have grounds for why you did not file or pay your taxes on time, or you're unable to meet your tax obligations. So So that's the situation where you can present your circumstances. You know, maybe you had a death in the family, or you had a natural disaster, burn down your house. You know, you had a flood. I lost my tax documents. I couldn't file my tax return. Everything washed away in the flood. I can't do it. So that's reasonable cause. There are other examples of reasonable cause as well. And then the other thing to know is, just like we talked about a minute ago, you can appeal the IRS decision. You can appeal if they reject your request to abate penalties. They are, well, anyway, you can appeal that. But let's say you do get your penalties removed, but it is a zero balance on that year. You don't owe anything. But you can move that credit to another year, and we've done that too. So let's say it's for 2019, you had $5,000 of penalties, but you didn't, like, you already didn't owe anything. Okay, well, I got my $5,000 penalty removed. Well, can I move that to 2021 and offset the money I owe for that year? Yeah, you can. So that's another strategy. Okay, so moving on to number 4 here, strategy number 4. This is cashing in on missed tax benefits from a prior year. Okay, so what does that actually mean? How do you do that? So here's the best way to describe that. There are opportunities to go back in time and grab money on the table, literally. And it's done through an amended tax return. Let's say you file your tax return and you say, okay, I've realized that I did not take advantage of a certain tax strategy that was available to me. I didn't know about it until after the fact. Okay, great. I'm going to file an amended tax return to go back and claim that money. You can use it to claim tax credits, deductions, alternative treatment of income, and all kinds of different stuff. And people, you know, we've talked to clients a lot, and they're hesitant to file an amended tax return because they're worried about increased audit risk. But that's actually not true. I can't even count how many amended tax returns we filed, probably over 100, well over 100. And we've never seen an audit. I've never seen an audit occur because of filing an amended return. Now, you can get audited on an amended tax return, but not because you amended it, but maybe because you reported something incorrectly. But just, you don't get audited necessarily just because you filed an amended tax return. You have generally about 3 years from when you can file an amended tax return to claim a refund. There are some exceptions, but it's usually 3 years. I will tell you, if you think you're going to file an amended tax return, just be prepared to wait a long time. They're taking 20 plus weeks to process those right now. So especially if you're due a refund, it's you're not going to get your money tomorrow. It will take a while, but they'll eventually pay you, and they'll pay you with interest if it was more than 45 days after the return's due date. So they will pay you interest as well. Okay, so that's one way to go back. You can cash in on missed tax benefits. Okay, so let me tell you the second real world story of the webinar. So again, this is a real client that we had. And this was in 2019 that the client came to us, and they had a couple years of unfiled tax returns. And so we prepared those tax returns. We got them caught up. We filed them. And during those 2 years, they had a large, substantial, unusually large couple years of income there. Okay, a very high amount of income. And because of that, they ended up owing the IRS about $300,000 for those 2 years. And, you know, speaking of penalties and interest, almost 160,000 of that 300,000, $160,000 was penalties and interest, which is insane. Like, just to think, you know, penalties and interest, 160 grand. So here's the thing: we delved very deeply into the client situation and asked lots of questions. And it turns out that the client had had a death in the immediate family and medical hardships, and the client was actually required to travel across country for an extended period of time repeatedly to care for this family member. And so they were taken away from their immediate regular life, and that prevented them from filing their tax returns and paying their taxes on time. So what we did is we prepared a penalty abatement and we explained all of these circumstances. And after this was filed, we received approval that removed over $117,000 in penalties and interest. I will say the client was very happy. They were extremely happy. So it took the balance of 300,000 and reduced it to under 200. It was like upper ones. It's still a lot of money, don't get me wrong, but hey, if you can shave off over $100,000 in penalties and interest, we'll take that. So that's a real story. And again, situations come up. You can't qualify for something like this if your dog had to go to the vet, or just little things like that. I mean, not that that's a little thing, but it has to be a major situation like this, like a client death or a death in the family. So that's a real story where we were able to help somebody. Okay, so let's see. Now we're at the questions. So if you have any questions as you've been listening, I would definitely welcome any and all questions that you have. So the way to do that is you should be able to raise your hand. So there's like a raise hand button on the bottom of your screen. And if you click the raise hand, then we'll be notified and then we can unmute you. Actually, you can unmute yourself. I don't think we can unmute you. And then you can ask your question, and I'll be happy to do my best to answer your question. So if there are any questions, please let us know. We'll be happy to do our best to answer them. Okay, once again, any questions at all? If not, we'll have an early wrap, but more than happy to ask or answer any questions that you have, and we'll be happy to try to do that for you. Okay, I'll give it a couple more, maybe another minute here. And if you would like to email us your questions, you're more than happy to, or you're more than welcome to do that as well. My direct email is adam@shortfinancial.com, ADAM@shortfinancial.com. If you prefer not to share those questions publicly on the recording, that's totally fine. But again, my email is adam@shortfinancial.com, and I'll be happy to engage with you and help you get to the bottom of your questions. So I think we're going to wrap. I think looks like we don't have any questions. So appreciate your being with us today, and hopefully this was helpful. And like I said, this is a vast world, IRS issues and tax questions and tax issues and controversy. So hopefully you found this helpful. We appreciate you being here. And if you have any follow-up questions, or if you have a real life situation, feel free to reach out to us. We'll be happy to talk about your case. And thanks again. Have a great afternoon.